critical market updates that you need to know. If you are a multifamily real estate investor or you're a real estate investor at all, and you're looking to scale in today's market, you've got to pay attention because today I have Randy, my partner here, Larry, my partner. We are diverse in many different aspects, but we have a strong focus of multifamily apartments. And there's some critical things. There's three things I want to walk you through today, August 14th, 2025, that I believe if you implement these things, we're going to share three key plays that if you implement these things, you're going to do very well in today's market and you're going to be able to be much more recession proof despite what's happening. There's a lot of tension in the market right now, things like president and Russian's president, the war going on, all different things that could signify different rate increases or drops and all kind of things. So with that, we want to focus on the main things, right?
Yeah.
Because the news is going to tell you all kind of things. But if you're an investor, it's critical that you keep your head down and focus on what's going to drive the needle the most. So let's go ahead and kick it off with point number one.
Yeah.
First update.
Yeah, for sure. Thank you so much, Jonathan. Great to be here with you. And it's what Jonathan said is true. You gotta focus on the underlying facts and realities, and not necessarily just grabbing the most recent clickbait on the internet or the most recent blast on what's going on CNBC or some crap, MSNBC or something like that. And so what you saw coming out most recently was a big movement on the jobs front, right? And on some level, they repositioned or restated the jobs down by 225,000 jobs. Like that's not a small number. So that your actual jobs report was like 72,000, and it was a non-growth type reality, meaning the jobs market is softening in the U.S. kind of underneath. And now whether that, Trump fired the girl that's in the statistics realm of the bureau, but whether it's intentional or not intentional, the government does a bad job. But what does that mean for us? Well, you saw the bond market instantly responded in reflection of that, indicating a weaker economy than what had previously been said. And that's where you saw, basically like a 30 basis point drop in the treasuries, the 10-year treasury specifically, which drives Fannie and Freddie. But I think ultimately for us, what does that mean? It means that when you look at the economy, you've got to begin to understand that there's some weakening going on within it. There is a pullback in a variety of companies, whether it's executing on capital, hiring, these kind of things. Again, and people I talk with, that's a reality. So what does that mean? It means that if the economy is slowing down a bit underneath, it's more in line with interest rates that have the opportunity to come down, because that's really where long-term rates are driven from, is from the bond market. And if we sense that there's more uncertainty in the economy, more money rotates into bonds. And so again, and then they're competing against the stock market. But for us as real estate focused people, we want to see those rates come down. And so there's a balance of seeing, keeping your eyes on the pulse of it. And then more importantly is seeing the reinstatement figures, because that's exactly what happened. Is here it's 300,000. Oh no, it's reinstated. It's only 76,000. So critical to be able to see that and what it means.
So good. Yeah, and so there's many places around the U.S. A lot of people ask us, where are you investing? Where's the best markets? And look, I think it's important that we address that because there's a lot of reports sharing, the Midwest and all different places that are experiencing more job growth in those areas, but really across the nation, there are a lot of these deals coming through. And I think that leads us to our next point as far as distressed properties coming onto the market and have already came, people that were in a finance, that with a low interest rate, and then they came into a higher interest rate environment, right? The refinancing options just aren't there, right? And so people are having to, exit, or they're having to sell for less. So there's a lot of opportunities like that coming on. I read investor sentiment has rebounded, and over 80% of multifamily investment pros plan to moderately or aggressively grow their portfolios in 2025. I read occupancy remains strong. rental growth is expected to stay in the 1 to 3% range. But how do you guys feel about just the distressed opportunities and how to capitalize on those, across the nation, not just in the pockets where the news is really focusing on?
Well, I mean, just exactly that. You saw this past month, Brookfield Asset Management, they raised $6 billion of a $16 billion fund with a heavy focus on multifamily and industrial.
Right.
And then, Blackstone just bought $2 billion worth of distressed commercial loans.
Yep.
These are not dumb people, right? Like they are raising a lot of capital, or like in Blackstone, already have a lot of capital, and their focus is exactly in this area. So, what
Exactly.
Jonathan just said is the truth, is that you've got these capital distressed properties that are coming to maturity or already past maturity, and that's presenting opportunity. And so you don't have to go to the Midwest. And I just make a comment on this, right? Like even on the Midwest thing, you're going to see Midwest, 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 and you've already seen it now for the last probably 60 days. You're going to see it for another 6 months to a year. And why is that?
Mm.
Well, Midwest had been more stable, had been more consistent cash flow. People in some areas had been, kind of, pressured and compromised, if you will, in operations, Southeast, Southwest, that kind of thing, just with some of the things that have taken place there. So steady Eddie in the Midwest, people are rotating there for a bit, they call it stronger cash flow. So now that you've got everybody in the country talking about Midwest, where are people focusing on? Midwest. And you go to the Midwest, and then that's going to have kind of legs underneath it for the next 18
Right.
months. And then what you'll see is these distressed opportunities that are going to be bought and exited on. And then people start, like, oh my
Right.
God, hey, this opportunity is over here in the Southeast, Southwest. That shift will come back. It's kind of like Wayne Gretzky said, you want to skate to where the puck's going to be, not where it is.
There it is.
Yeah.
That's
Yeah, and a
good.
lot of people, not only the interest rates got them, but they just overpaid to start with because of the continued optimism that was going into the market, thinking cap rates are going to continue to compress. But yeah, the good news is lenders did not loan those people 100% of the purchase price. They only loaned them 60 or 70 or 80%. So while their equity was getting evaporated, you can come in and maybe get it for a little over the debt, right?
100%.
Or for the debt, the amount of the debt. So a lot of opportunities out there in a lot of locations. Go where everybody
Yeah.
else is not going, right? Like,
That's good. That's good. And I was just reminded of that quote Warren Buffett said, if you were to promise me that next year there's going to be a depression, there's going to be a tank in the market, if you were to guarantee that, I would still be investing in the same assets and selling the same securities I'm selling right now. Would not change a thing. And so I think it's important for a lot of investors to see that there's a lot of these opportunities coming. So you've got to navigate with the market, but the multifamily value add is just such especially the 10 to 100 unit range. It's just a massive opportunity that you got to keep your head down, keep focused on. And I was just reading. There's even smaller groups are now doubling their portfolio because of the opportunities. These distressed properties. They're looking for loans being matured and sellers that are owners that the deal has been delayed or it's been in distress. And people are able to grow quickly if they can really identify these opportunities and they're looking for that. So yeah, big point right there. And just so people know, the multifamily loans are maturing, meaning now they're due, and the lender has the ability to increase the interest rates to the current interest rates. And so, the people underwrote the deal thinking it was going to come down. And, a lot of people think, well, Trump's going to decrease rates in May and probably will, right? And that's great news, but we don't underwrite, we don't count on that whenever you're looking at multifamily deals. You focus on value add appreciation, forced appreciation, and that's what is really the safe bet. That's really what we need to be focused on right now. So let's move to point 3.
Yeah, I mean, I think too, you see what has been the underlying reality of inflation moderating in the most recent inflation report that just came out on Wednesday. And that also was where, the confidence level of a rate cut for September skyrocketed to, over 90%, meaning it's like the Fed has clear reason to begin cutting rates now. You've got jobs that are weakening, as evidenced by the jobs report that we talked about. And now you've also got kind of all the tariff stuff going on, and inflation has not moved as what they expected. And so that is a great bellwether right there that we have to pay attention to. And then the reality is I think Larry said, yeah, the rate cuts are on the horizon.
Yeah.
Yeah, that's exciting. Yeah, most likely next month, right? We'll get another cut, which will create opportunity. But the best investors have the key ability to see what's coming, right? I mean, the people that are highly successful, they have a vision to be able to see what's coming. And a mentor of mine said, told me a long time ago to create my own economy. Don't worry too much about what's going on in the national economy. But you have to have knowledge, and you have to understand the bigger picture, obviously, to be able to have that vision of what's coming. But you have rates coming down, and that creates the ability to go out and take down deals and plan your underwriting and buying the deal based on those rates.
Yeah.
Well, yeah, and I mean, there's a reality that, and again, again, Larry just spoke very aptly, but you've got meetings coming up. There's 3 meetings left for the Fed this year: September, October, December, and there's a possibility, and or some would say a probability, that there could be rate cuts at all 3 meetings. Now, again, it's going to be distinguished on what transpires in the underlying data, continuing with inflation and jobs numbers. Those are going to be big drivers, because also Jerome Powell doesn't want to look like a whipping boy from Trump, right? Like, I mean, Trump's been riding his butt about, cut, fire him fast and fire him soon if I can. And then now what? Powell's going to be balanced with, all right, he's got to, pretty much got to cut rates next month in September. But then, if he's being reasonable and fair, there's really data that could support October, and then depending on what shakes out between the next couple of months, December as well. And so that would be that would be awesome. I mean, now
we could potentially have 3 more. Could potentially have 3 rate cuts, right?
Yeah. I mean, he's not going to cut
year
by 50 basis points in September. I mean, it's probably 25 because the market would overreact.
Right.
But that would be great, man. I mean, 75 or even 50 basis points between the end of the year, dropping from 4.25 to 3.75. That's a good move, and it helps on bridge loans. It helps psychology. Jonathan mentioned investor psychology. Like, buyers start like, hey, rates are coming down. You know what I mean? And so ultimately, I mean,
a lot of people are just in a holding pattern, right? And it's not for a lot of the reason is just the sentiment, right?
Yeah. Well, and I would say this: capital, even equity people are let's wait and see. It's like, now is the time to begin to move forward, because you can underwrite the deal. And like what Jonathan said, quote from Warren Buffett, hey, this deal works at the numbers right now at this rate. And so you make money with the value add proposition with this rate. And then as rates would come down, you're then doing even better. But it's not predicated on. I've seen some deals floating around on the internet, and it's like they're basing it on, hey, we're going to make money by the rates going down, right? You know what I mean? And it's like, well, if rates don't come down that quickly, you're kind of screwed, man. It's like, so you should have learned from what Larry said about buying thin in 21 and 22 when rates went up. Like, you don't want to buy thin now if rates stay stable, because that could happen. You know what I mean? Like, it's like, you don't want to be like, oh my God, rates have got to come down in the next 12 months and I'm crushing it. It's like, that's an added bonus.
Yeah. And I mean, so whether your strategy is expanding your portfolio or shoring up or trying to, keep your returns consistent or maximize returns, you need to understand these market cycles and how these things take place, because there's so many opportunities, but at the same time, if you are expecting something that's not going to happen or may happen, you could find yourself in the same situation that's created the opportunity right now, and that's people that are coming, their loans are coming due, and they aren't prepared for it, right? They aren't prepared for the current market interest rate. So you got to understand these things. And so, I love, drop in the comments on this video, drop in the comments where you're investing, what your strategy is. What are you currently doing? Are you refinancing? How are you approaching deals right now? Randy, Larry, I'd love to hear, for those that are watching and want to be aggressive in acquisitions, want to get out there and take deals down in today's market. How would you advise them to focus with the upcoming situation in the government?
I mean, I would say two things. One, you've got to have a focus on operations 100%, no doubt, right? Like, and whether it's your first deal or your 10th deal, you need to be able to be focused on operations, because I've said this time and again, this is going to be the decade of operations, And what I mean by that is it's a tighter environment. Anybody that tells you they haven't experienced pressure in commercial real estate in the last 3 years is either lying or stupid, or maybe they own one deal that that they babysat for the whole time with a fixed rate loan of 4%. Apart from that, operations matter, because you've got, like Jonathan said earlier, there was more supply coming in the market last year. Rents were not as strong in many markets. You've got interest rates that were up so dramatically, so quickly in 22, 23. So having your operations dialed in is key. And then also being able to be focused on what is your acquisition focus. Like, not just going after anything and everything, but having a particular focus that makes sense for you, and you and your team can execute on it. That's key. Execute on it. So those two things are going to be critical, because, like, look, you go out and buy 3 deals because you're executing on acquisitions, but you don't have operations to support it. That's going to be a challenge. If you focus on trying to get everything, you usually get nothing.
That's good.
And we're focused heavily on operations. We're still in the acquisitions game, but somewhat in that waiting mode. But if you're in heavy acquisitions mode, you have a huge advantage, because a lot of people are on the sidelines. A lot of people, because they have to be on the sidelines, but some just they want to be. They're waiting. So now where rates are. Where the economy is. It's been pretty consistently not good for a while now. so you've got, and rates probably are, I don't know if they'll ever come back to 3.5%, and for long-term debt in my lifetime. Probably gonna be in the 5s or 6s, right, Randy?
Yeah.
So you can act accordingly, and you have the opportunity to get in there on deals. Now, for realistic, the deals we're making offers on, there's a lot fewer buyers, a lot less competition. Or also, there's a bigger spread from what the seller wants and what we can pay. But there's still some that work. So you got to get out there and, network your tail off, right? Whether you're looking for distressed super deals from a bank, or whether you're looking from a direct to seller who's maybe he's been out of the country, been away for 10 years and don't know what's going on, and you can scoop up a good deal. And some people just got to sell because they've gotten, they just got to sell. They got to take what the market will bear. They can't. You can hope and dream for a certain price all you want, but you're only going to get what the market will bear, right?
I would echo this too. The leprechaun from the Lucky Charms cereal box is not going to skip in and just drop a deal in your lap. You know what I mean? Like, you've got to take the effort and energy, like Larry said, with the focus on what you're going after, and get out there and do the work to find it, right? Because even if it is, say, there's distressed properties coming in, look, we had 4 come in through our network the past day or so, and probably 3 of the 4 were trash, right? Like, I mean, yeah, they're distressed, but they're no good. And so, again, you get on the internet and it's like the little fairy dust is going to sprinkle gold onto you, and you're just going to have it fall in your lap. It just doesn't happen that way. So, you got to gear up and get out there. And like Larry said, you got to do the work, and you got to kiss a lot of frogs to find a prince, man. That's the truth. You know what I mean? And so
that's good.
You got to do the work.
Look,
and you're ahead of the game. the head of the game, right?
You know, a friend of
Yeah.
mine told me this. This is a good friend of mine, real estate attorney, high level investor for 40 plus years, real successful guy. He was probably one of my first guys that I bought a multifamily with in 2003. And we connected. And when going through the crash of whatever, 2008, 9, 10 kind of era, and we're just, man, we're working through it and banging through it and going through it. He said, him and I met, and, you know, regularly. He said, Randy, you're going to be light years ahead of everybody else. Because at that time, it became so difficult. Most people just kind of pivoted away from real estate, you know. And he's like, by you doing the work and moving through a lot of these challenges and difficulties that exist in the market, when the market comes back, and it will come back because it always does, you're going to be so far ahead of everybody else because they're going to be coming back where you already been in it and you've been sharpening your skills through it. And he was true and right. And I would say the same thing, and it echoes what Larry said, is by you putting in the work right now, even if it doesn't appear fruitful, meaning you got a deal out of it, you're still sharpening the skills, and you're going to be light years ahead of other people that are just sitting back.
So good. Look, guys, if you are serious about growing in real estate, growing in multifamily, this is the year. This is the time. August 14th. This is the time to be investing. I mean, right now you're seeing the supply is thinning out. You know, there's very tight supply now. So rent growth is growing. You know, we have a lot of opportunity with distressed opportunities, distressed value add apartments, you know, loans coming due, and really just, you know, the big, beautiful bill, right? We haven't even talked about that, but, you know, that's something that we'll talk about for another time is, you know, Trump made this tax bill that now you can get 100% bonus depreciation. You know, you get a $5 million deal, you're able to do a cost seg study and write off $1 million on your taxes, right? So you say, I don't even need that. Well, it does roll over a lot of times into years to come.
Yeah.
So I mean, look, this is a monumental opportunity to be in multifamily. And so if would love to hear in the comments if you're focused on growth, love to hear it. You know, let us know. We'd love to support you however we can. We actually have a live masterclass coming up Saturday. We're going to be doing a masterclass at 12 p.m. Eastern time this Saturday in a couple of days. So it's completely free. We're going to be hosting a training. So if you want to jump on that, I'll drop a link in the description for you. Just go ahead and opt into that, and we'll see you on there. But we're going to be walking through exactly how to find these deals, find off-market deals, how to get them funded, how to bring capital partners on, how to structure these deals, all that kind of stuff. Would love to see you there. But either way, appreciate you guys joining, and it's been an awesome time. So thanks, Randy and Larry.
Thank you.
Thanks, Jonathan. Good to see you, Randy.
Good to see you too, buddy. Take care now.
All right, guys. God bless.